Hello everyone, we are from Group 7 and today we will be presenting our financial statement analysis of Petronas Gas Berhad. Throughout this presentation, we will be evaluate the company financial performances, positions, and overall financial health using the key financial statement analysis. So let's begin.
Assalamualaikum, my name is Imran and I'm going to present about Petronas Gas Berhad corporate company background. Incorporated on 23 May 1983 as Petronas Gas Sendirian Berhad is a wholly owned subsidiary of Petroleum Nasional Berhad, and today it stands as Malaysia's largest gas infrastructure company. Its core business spans three segments, which is gas processing and transmission through a network of over 2,600 km of pipeline LNG regasification via two terminal, which is RGTSU, commissioned in 2013, and RGTP in 2017, with a combined capacity of 990 MMSCFD, and ongoing growth project including the Pulau Indah and Banting pipeline and the Sipitang plant. On regulation, its gas transportation and regasification and business cooperate under the incentive-based regulation framework set by Energy Commission with operation spanning Peninsular Malaysia and the state of Sabah. Now let's look at Petronas Gas Berhad 4 pillars of sustainable value. The framework guiding how the company creates long-term responsible growth. The first pillar is sustainable value creation, overseen by the Board Sustainability and Risk Committee with IFRS S1 and S2, climate disclosure set to begin in 2025. The second pillar is a safeguard environment rests on 4 decarbonization levers, which is eliminating routine flaring and venting, improving energy efficiency, adopting low carbon and green energy source, and investing in carbon capture and storage or CCS. The third pillar is a positive social impact, which places strong emphasis on occupation safety and health, maintaining ISO around 45001 certification across operation. And finally, the fourth pillar is a responsible government, reflect the company's integrity in practice, which is zero corruption incident recorded, a dedicated data protection officer appointed, and a FTSE for good source.
PGB financial analysis for 2021 until 2025 show an active strategy to reduce debt dependence, with borrowings dropping sharply by 55.8% and cash decreasing by 48.8%. In contrast, trade payables surged by 107.9% and fixed asset investment rose by 17.6%. On profit side, although revenue increased by 12.8%, gross profit fell by 21% due to margin pressure, causing the gross margin to drop from 48.1% to 33.7%. However, the positive impact of debt reduction successfully lowered financial costs by 52.8%. Overall, while net profit and EPS remain below 2021 levels, PGB financial position is now stronger, and the company's main focus is recover its affected profit margins. PGB financial analysis show the company actively invested in fixed asset using internal funds, causing cash to drop by 25.35%. At the same time, PGB reduced long-term debt by shifting to trade credit, which caused payable to surge by 60.41%. However, profitability suffered as revenue growth slowed to negative 2.51% in 2025, alongside rising costs, causing net profit to drop by 16.72% in 2022 and 4.53% in 2025. In conclusion, this study case shows that PGB is facing several margin and cash pressure even as it successfully reduced its debt burden.
Move to the common size. On the balance sheet, fixed assets rose from 69.80% to 78.76% of total assets, while the cash fell from the 90.71% to 9.78%. On the financing side, the total equity rose from 69.53% to 74.23%, and the long-term debt was cut from 70.9% to 7.9%. However, trade payable more than doubled from 5.57% to 11.22%. PGB is clearly swapping cash and bank debt for the fixed asset and supplier credit. On the supplier income statement, the cost of revenue climbed from the 51.85% to 66.31% of every ringgit earned. This structural cost pressure hit margin directly. Gross profit margin fell from 48.50% to 33.69%, and the net profit margin shrunk from the 37.38% to 28.81%. Next is index. On the balance sheets, fixed asset hit a peak index of 117.57 by 2025, while the cash plumped to just 51.23, less than half of where it starts. Meanwhile, long-term borrowing dropped to an index of 42.85, but the trade payable surged to 207.89. This chart the strategy perfectly. Growth is being funded by equity and trade credit, not a bank debt, but the income statement highly demand challenge. Revenue only grew to an index of 112.84 by 2035, while the cost of fraud to 144.30, growing the 3.5 times faster than sales. That gap is exactly why gross profit fell to an index of 78.96 and the net profit to 86.98.
Assalamualaikum, my name is Iskandar, and today I will present about the financial ratio analysis. So first, let's take a look at the financial results from year 2021 to year 2025. Starting with liquidity, the current ratio compressed over the 5 years period, dropping from a highly liquid 3.64 times down to 1.23 times. The quick ratio followed the exact same downward trajectory, moving from 3.61 times to 1.22 times. On the operational side of liquidity, efficiency remained incredibly tight. The average collection period improved from nearly 21 days down to 19.23 days, while the days to sell inventory was cut nearly in half, shrinking from 2.09 days to just 1.14 days. So moving on to the leverage, the capital structure became much more linear. The total debt ratio peaked in 2022 at nearly 32% before dropping down to 25.77% by 2035. Debt to equity ratio similarly decreased from 0.44 times to 0.35 times, showing reduced reliance on debt. The biggest highlight here is solvency. Time interest earned skyrocketed from 15.20 times in 2031 all the way up to the massive 27.24 times in 2035, meaning the debt servicing capacity has never been stronger. Finally, let's take a look at the activity ratio, which show a massive operational acceleration. Cash turnover doubled from 1.49 times to 3.03 times, and the working capital turnover jumped from 1.65 times to 4.86 times. Most notably, inventory turnover exploded, surging from 63.74 times to 117.14 times. While total asset turnover held a steady around 0.33 times, the company is moving its internal cash and inventory at much more faster velocity than 5 years ago. Let's dive into the core of profitability ratio from year 2021 to 2025. The gross profit margin experienced compression, sliding from 48.15% down to 33.69%. Despite that squeeze, the operating profit margin held remarkably resilient, adjusting from 47.08% down to a steady 35.29% by 2035. The net profit margin followed a similar pattern, tracking down from 37.38% to settle at 38.81%. Looking at the asset efficiency, return on asset remains stable, hovering between 11% to 9.52%, while return on equity moved from 15.83% down to 12.69%, showing steady baseline return for investor. Now for the market metrics, earning per share dipped initially but recovered to close at 87.3 cents in 2025. This left the price to earning ratio trading comfortably at 19.47 times up to 16.92 times in 2031. For income investor, the results are highly consistent. The dividend yield stay in a dependable band, moving from 4.82% to 4.41%. This yield is backed by an incredibly aggressive payout policy, with the dividend payout ratio climbing from 81.58% down to a high of 91.64%. Finally, the price to book value remained exceptionally stable, softening just slightly from 2.57 times to 2.36 times. Moving on to the prospective analysis, Petronas Gas Berhad revenue is projected to climb from 6.6 billion to over 7.5 billion ringgit by 2030, driving cooperating profit up to 2.3 billion and net profit of 2.18 billion ringgit. This growth fuels heavy balance sheet optimization. Systematic debt reduction will propel our short-term liquidity, lifting the current ratio from 1.47 times to a robust 2.66 times, while dropping our debt-to-equity ratio to an ultra-safe of 0.24 times. With a highly stable 12.6% return on equity and a strong 26.5 times interest coverage, EPS will reach 110.3 cents, lifting forward dividend yield to a resilient 5.67%.
Now, I will close out our analysis with the discussion and recommendation for Petronas Gas Berhad before wrapping up our presentations. Overall, PGB is financially strong but facing two emerging pressures, which is structural margin erosions and a sharp decline in short-term liquidity. On the strength side, PGB has excellent solvency. Its debt ratio and debt-to-equity ratio have both fallen steadily, backed by a time interest earned that never dropped below 24 times in 5 years. Its dividend profile is equally compelling, with payout consistently above 86% and yield around 4 to 5%. On the weakness side, the current ratio dropped from 3.64 times to just 1.23 times, driven by a rising trade payables, funding capital expansion, and a cost of revenue that has been growing faster than a revenue, a structural issue that the regulated tariff system that can't possibly price away. This gives PGB a moderate to high investment appeal, which is best suited to income-focused, risk-averse investors rather than those chasing short-term growth. Its low leverage, strong interest coverage, and revenue visibility under IBR framework support a reliable dividend outlook, which is projected to reach 5.67% by 2030. That said, investors should watch two things closely, which is the liquidity that expected to recover to 2.66 times by 2030 but needs monitoring in the near term, and margin pressures, since current profit stability partly depends on JV income rather than core operations. In conclusion, Petronas Gas Berhad demonstrates a strong overall financial position for the period 2021 to 2025, supported by disciplined leverage, high interest coverage, and resilient dividend track record, backed by its regulated business model and relationship with Petronas. However, the analysis also identified two key concerns that require close monitoring going forward, which is a sharp decline in short-term liquidity that driven by growing reliance on trade payables and short-term borrowing, and structural margin compressions as cost of revenue continues to grow faster than revenue under the incentive-based regulation tariff framework. The prospective analysis suggests these pressures are expected to ease gradually, with liquidity projected to recover and dividend yield projected to rise to 5.67% by FY 2030. Overall, PGB remains a low-risk, dividend-generating investment suited to income-focused investors, provided its liquidity position and cost pass-through capacity that manage effectively in the near term. That concludes our full analysis of PGB, from the comparative and ratio analysis through to our prospective outlook and today's recommendations. Thank you for watching and thank you for listening.